Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors first quarter 2016 performance updates. I will be providing a brief first quarter performance overview of all the iSectors models and conclude with a near-term economic perspective on the markets. This call shall last about 15 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the lower right-hand corner of your screen. This presentation will be recorded and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar attendees immediately after this call. The post-MPT allocations outperformed their benchmarks in the quarter. Post-MPT was led by utilities and treasury bond holdings. Both strategies were hurt by financial stock allocations. As the chart on slide 3 indicates, post-MPT growth continues its shift of its allocations towards safe haven assets. The model continues to significantly de-emphasize stocks. A large majority of stock positions owned are in sectors such as utilities, real estate, energy, and gold. You will also note that the allocation emphasizes bonds. Since the strategy's benchmark is the Standard & Poor's 500, the model is indicating that Treasury bonds is currently the most attractive asset class. iSectors post-MPT growth continues to outpace other ETF strategies. We are pleased that the allocation is ranked 5th among 504 ETF strategies, or the top 1%, for 5-year performance, and 10th out of 203 strategies for 10-year performance in the Morningstar ETF Managed Portfolio database. We expect post-MPT growth to continue its reputation as one of the premier allocation strategies utilized by investment advisors. A number of allocations were helped by rising commodity prices in the quarter. Endowment outpaced its balanced benchmark, while liquid alternatives outperformed hedge funds. Investors turn to the commodity markets as cheap assets uncorrelated with the falling stock market. As the chart on slide 4 shows in black, precious metal stocks have been in demand all year. The chart also plots in red the volatile price trends of one of our market neutral funds. The listed private equity holdings also hurt results in these models. Both allocations are broadly diversified and will continue to take advantage of the bullish commodity market. Also, it should be noted that liquid alternatives has outperformed hedge funds over the past 5 years. Given the advantages of the allocation, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of 3%, liquid alternatives should be considered for diversification in case equity returns ease. Domestic equities again outperformed global equities, and they both bested the Standard & Poor's 500. Both allocations benefited from an emphasis in dividend stocks, which are now outperforming growth stocks. The global fixed income allocation was negatively impacted by short-term tips and floating rate bond weightings in the quarter, while international bonds benefited from the decline in the US dollar. The iSectors domestic equity allocation has earned very attractive returns over the past 5 years compared to most ETF strategies. In fact, the domestic equity allocation is ranked 7 out of all 504 ETF strategies in the Morningstar database for 5 years performance. Again, iSectors is proud to be the only investment manager to have two strategies, post-MPT growth and domestic equity, in the top 10 of all ETF strategies over the past 5 years. The commodity rebound positively affected our inflation protection and precious metals allocations in meaningful ways. Inflation protection up over 7% in the quarter, and precious metals up over 15%, benefited from rising gold prices. Thus, as you see it in the chart on slide 6, for the Sprott Physical Gold Trust, which holds gold bullion, the fund has had a greater than 22% rise so far this year. Timber and energy holdings negatively impacted the inflation protection allocation. As you can surmise from the Sprott fund chart, the inflation protection and precious metals allocations continue to have a positive second quarter. We continue to believe that a 10% to 20% allocation to precious metals, inflation protection, or liquid alternatives will be worthwhile, given the view that the next 5 years in the equity market will not be as profitable as the last 5 years. As the chart on slide 7 indicates, capital preservation has earned over 2.3% on an annualized basis over the past 5 years. The yield is attractive with a short duration while maintaining investment grade quality on average. Capital preservation rose during the quarter, mainly due to short mortgage and high yield holdings. Finally, the tactical global balanced allocation underperformed its 60% stocks, 40% bond benchmark in the second quarter. Although the allocation started the quarter with only real estate and cash holdings, it added bonds and gold as the quarter went on. It has recently become fully invested in all major global asset classes. As presented on the chart on slide 8, the late January bond purchases in this strategy resulted in positive returns for the quarter. Wall Street discounts the future, wrote Charles Dow, the founder of the Wall Street Journal in 1899. If this is true, what does Mr. Market see for the rest of 2016? One way to analyze the market's movement is looking at the broad averages. Since the large cap indices are up and the small and mid cap indices are down, they do not give much direction for the balance of the year. A more precise way to spot trends is to look at the sector results presented on slide 9. Technology is the worst performer so far this year. It indicates that the business investment slump seen in the first quarter GDP numbers are likely to continue. Healthcare's decline has a capital spending component, since biotechnology has the worst results for the industries in this group, and a consumer component, since pharmaceuticals is the second worst group performer, that both foresee weakness ahead. And financials round out the bottom groups with real estate services, investment services, and mortgage finance, all indicators for the economy, leading the decline in the sector. On the positive side, utilities has staged a major comeback after a long period of underperformance. When utilities outperform, it means the market is not sanguine about the economic road ahead. Why would oil and gas be so positive given weak first quarter earnings and lower energy prices than a year ago? Well, it seems that the market is attracted to its real asset status. If economic growth looks sluggish, it may be a better course of action to hold on to a historically cheap, tangible asset. Finally, telecommunications has outperformed for similar reasons as utility stocks and foreshadows slow economic growth ahead. This analysis clearly indicates that the stock market sees economic trouble in the coming quarters. The safe havens of high-yield stocks and tangible assets have outperformed more economically sensitive sectors. The iSectors quantitative model expects this trend to continue. If it is correct, the Federal Reserve will not raise interest rates this year. Thus, there will be continued demand for safe haven assets, including long-term treasury bonds, utility stocks, and tangible assets. iSectors allocation, including post-MPT growth and moderate, inflation protection, and precious metals, address this expected environment well. As you carefully inspect the disclosure page, we will now begin the Q&A portion of the webinar. If you have any questions, please type them in the chat box in the lower right-hand corner of your screen. The first question we have is, when the REIT becomes its own sector, how will this change your sector rotation program? Well, as you know, we have always had a REIT component to our quantitative model and thus to the post-MPT strategies. And even though the REITs will become its own sector, it'll be obviously, it's a good thing because it would recognize that it is really has its own economic drivers. We expect to continue to use REITs as we've used them in the past, and we hope, because it's its own sector, that it will get more attention among investors. The second question I have here is, do you see any rate rises happening this year? Well, we certainly, as far as the market is concerned, there'll be volatility. Rates will go up and down. We just experienced a rate rise for the 10-year into the 190s area. Now we're back down into the 170s as of today. We think that the market is going to go back and test the 150s to 160 area that it hit earlier this year, and maybe even go below it. And so we're positive on interest rates because of that. As far as the Fed is concerned, as I indicated in my prepared comments, we do not think that the Fed is going to raise interest rates this year. The first quarter earnings still look like they're going to average about down 8%, with 7 or 8 sectors of the 10 sectors of the S&P 500 actually having declining earnings in the first quarter. So we can't see how the Fed is going to raise rates in June. And then we're going to start getting into the election season, and the Fed is not likely to want to raise rates in front of that. And so the question is, how are things looking in December? Hopefully we will be in a recovery by then, but the Fed may just decide to wait to 2017 to raise rates again. The next question is, we are with Transamerica currently, but in 10 days they're going to be acquired by John Hancock. Currently, iSectors is not a available strategy. Will this change soon? Well, we certainly hope so. We are always working to expand our distribution. I don't have any specific words on Signature or Hancock, but as soon as we have any word on that, we'll make sure that advisors that are affected will know about it. Are there any more questions? If not, then I would like to conclude by thanking everyone for attending our webinar this afternoon. If there is anything we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. We can be reached directly at 800-869-5184. Again, thank you, and I hope you all have a wonderful summer.